So guys, welcome again to today's session. We'll be talking about liquidity, and after that we'll be diving into the sponsor candle, order block mitigation, and maybe after that, if we have enough time, we'll target what inefficiency. All right, so when we talk of liquidity, I know you guys will have some minor idea about what it is. Per strategy, will have a way of defining it, in the sense that it will suit our understanding to how to use the strategy. Right, so first of all, liquidity is defined by stop losses. Where the stop losses exist is where the liquidity also exists. So you can be making notes. I'll go over again. I said liquidity is defined by stop losses in the market. Where the stop losses exist is where liquidity also exists. All right. So smart money needs to activate the stop losses of existing orders in the market, so they can place their positions in the market. So this basically the reason why liquidity is a major concept of smart money trading. You get it? When you are able to identify where liquidity lies. In other words, where the definition of liquidity is where stop losses are. You get it? So we, as the smart money traders, we always want to take the opposite of what the retail traders are doing. You get it? So we are going to be using their stop losses as our entry point. Are you getting it? So we wait after their stop loss is being hit. That's where we will also come in for our position or enter with a bounce. All right. So liquidity induce sellers and buyers. You get it? There's the reason why I'm saying liquidity induce sellers and buyers. We have early sellers and we have early buyers in the market. As I explained yesterday, the retail traders, they sell early and they also buy early. You get it? So when price induces them, after inducing them, that's when we come in. Okay, so the banks manipulate the price because of liquidity. Sometimes when you are in a trade, then you realize is when you be in 5 pips in profit, 10 pips in profit, then you realize your stop loss gets hit. I get on it. So they manipulate the market, or they manipulate the price in order for them to get a position to place their order. I get on it. They do manipulate your order in order for them to get a position to place their order. So sometimes you ask yourself, why does this manipulations in the market happens? You get it? So the banks negotiate large trading volumes, and sometimes find it difficult to find the other side of their trades. So this is the main reason why they manipulate the market. You get it? They enter the market with a huge volume of trading. So because it's a huge volume of trades, they don't sometimes find it difficult to locate where their orders are. So what they do is they manipulate the market, or they manipulate the price, so that they can place their positions in the market. Okay, so there's basically the definition or the reason behind the manipulations in the market. So whenever you see a manipulation, is basically the institutions trying to manipulate retail traders for them to find a position to place their orders in the market. All right. So we'll move on to, we have two types of liquidity. We have two types of liquidity. So the first one is we have the buy stop liquidity. Alright, so there's the first type of liquidity. We have the buy stop liquidity. The second one is the sell stop liquidity. So these are the two types of liquidity that we have in the market. We have the buy stop liquidity and the sell stop liquidity. Right, so when we talk of the buy stop liquidity, is originated by what stop losses of all sales orders. Get it? It's what originated by stop losses of all sales orders. So after the buy stop liquidity is taken, the market reverses to the downside because the banks uses the buy stop liquidity to place sell orders in the market. So these are the reason why the buy stop liquidity exists. So let me go over again. I said what the buy stop liquidity is what originated by stop losses of all sales orders in the market. So whenever this buy stop liquidity is taken, whenever it's taken, as in, let's say if we are in the bullish market, we have this equal highs over here. So whenever the buy or every day, always the buy stop liquidity is always found above what previous highs, like it's or equal highs. Good. So it's always located above previous highs or equal highs. So whenever this buy stop liquidity is taken, price reverses to the opposite direction. I get in it. So price then retraces to the opposite direction. So we have price trading to the upside. Then after it takes out liquidity, or what happens now is it reverses to the opposite direction. Okay, so this is what the buy stop liquidity. Alright, so the market reverses to the downside because the banks use the buy stop liquidity to do what? To place sales orders in the market. So if it's said that institutions they place sales orders in the market, what have to come into your mind is what they want to go short. I get in it. So they are using the retail buy stop. I get in it. We have when on the MT4 you always see we have what market execution, buy stop, sell stop, sell limits and buy limits and other stuff. So what the institutions use to place their orders is what the buy stop liquidity. Whenever they want to go short, their sales orders, they place what a buy stop liquidity. So they place their orders at where the buy stop liquidity is. Meaning we have the breakout traders. Get it? So they uses the buy stop orders. I get in it. So there's breakout traders uses the buy stop for their entries. You get it? So when assuming price is trading to the upside and it gets to their buy stop points where they want to enter their position at price, that's what it triggers, and what sometimes it goes in their favor. I get in it. All right. So this buy stop is where the smart money traders or the institutions they use for their sell orders. Yet whenever they want to go short, they use the retail traders buy stop positions. So what the idea of it is what they first take them out to then they what for when they take them out as what their stop losses. You can see that their stop loss will be below this equal highs or what's previous high. I get it. So whenever they trigger them, let's say 2% profit